Perhaps you're a regular listener to this show, but you often wonder, why aren't other advisors talking about income the way we do? Well, stay tuned to this week's episode of the Retirement Income Source, where it's all about the income. Welcome to the Retirement Income Source, where it's all about the income. I'm David Scranton, here with my good friend and co-host, Sarah Samuels. And today we're going to be talking about our favorite topic, of course, which is investing for income. But also, more specifically, why others aren't talking about it the way we do, and why, and frankly, why a lot of investors aren't investing for income, even though perhaps they should be.
Dave, it's great to be here with you, of course, and with all of our listeners out there as we cover investing for income. It's an extremely important topic, especially since we talk about the different aspects of income, but we don't often talk about why other advisors aren't looking at it. And speaking of which, Dave, I didn't get to see much last week. I know that you were actually meeting with a group of our retirement income source advisors, probably to talk about investing for income.
Well, it was actually quite interesting because I got a sense from everyone, in fact, not even a sense, it was said explicitly that in some ways they all feel as though we're missionaries. You know, we're missionaries really trying to get a message across to people that there is an alternative to investing for growth. And it's really nice because when we have, those types of conversations, people they realize that, hey, we have a great uniqueness in what we do, and we love it. From a business perspective, we all love the uniqueness, right? It gives us a competitive advantage. But also from what's in it for the greater good, we really want more of the public to know, more of our listeners to know that, hey, there is an alternative now. And that's why today we're going to be dispelling a lot of the myths about that you hear out there from a lot of financial advisors, and why investing for income might just be the right answer for you.
Right. It's almost like the right messaging. All of you are messengers. You're income missionaries, if you will, because it is a better way to invest. Yeah. It's a more secure, more reliable way to invest for retirement. And you guys are trying to spread this good word essentially out there when there is alternative messaging going on.
And I think what happened over the years, Sarah, is that Wall Street got really into total return. And total return became irrespective of whether it came from income or growth. So, we always talk about the equation, TR equals I plus G, total return equals income plus growth. Income meaning interest and dividends, growth meaning capital appreciation, right? Well, so first of all, Wall Street looks at it and says, hey, total return, people want to make money on their money. And that's true. But doesn't always have to be irrespective of how much comes from the I or from the G. But I think the second issue, Sarah, is that then they've started to conflate the word growth with total return, where now when people say they want growth, they don't really want growth. They want total return. They want to make money on their money. They really don't care so much where it comes from. But because it's become synonymous now, everybody thinks growth, 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 without realizing that they can get total return by focusing on the I also.
Absolutely. And that's why we focus on that all-important equation, of course. Total return equals income plus growth, and total return is not synonymous with growth. So let's get into our question, which has to do with this exact topic. So we have Jim from Louisiana. He says, if I invest for income, does that mean I'll get less total return overall?
Well, Jim, first of all, congratulations. Thank you for asking with the word total return versus saying less growth. The reality of it is if you get 3% more on the income side, well, then that means you can get 3% less on the growth side and get the same total return. So sometimes people say, well, can I, do I get less growth if I get more income? And sure, that's possible, but it doesn't mean you get less total return. So, Jim, I appreciate you asking that the right way. And one of the things I often refer to is the fact that lots of studies in academia have said if you invest in high dividend stocks versus just growth stocks, over the long run, you can actually get more return, total return even, through high dividend stocks. And there's also a lot of studies in academia that say even on the Standard & Poor's 500, right, the S&P 500 index, that somewhere between 35 and 40% of the return over time comes from dividends. We're going to talk about that more later in the show, Jim. So that's really proof that you cannot ignore dividends. You cannot ignore income. But even on the side of what I call bonds and bond-like instruments, right? Let's say you can get 6% yield in a portfolio like that. Well, how much is the stock market going to return over the long run? Maybe 10%. Well, here you're able to get 6% in an assured thing, a more secure thing through bonds and bond-like instruments, which means you only need to get 4% from growth to match the market. Whereas when it comes to the stock market, if you're growth oriented, you're getting very little income. It all has to come from the G. So a lot has to go well in the financial markets. So Jim, yes, you might get a little less growth, a little less of the G by getting more I, but it doesn't mean you get less total return. It just means it's coming from the I instead of the G. Great question, and thank you.
Yes, thank you, Jim, for sending in your question. And if any of our listeners out there have a financial question or maybe a question about retirement that you would like to, all you have to do is send us an email to @retirementincomesource. That's SOURCE.com. You're listening to the Retirement Income Source, where it's all about the income. I'm Sarah Samuels here with David Scranton, and we're talking about the different things that you might be misunderstanding when it comes to investing for income. And it's really not your fault if you're misunderstanding. Unfortunately, there's been a lot of messaging out there from the media, from different financial advisors when it comes to investing for income. So, Dave, you just dispelled one of the most important myths, which is that total return is not the same thing as growth, and that you can have less growth but still get more total return overall when you look at the income.
That's right. And you think about it as like real estate, right? If you have real estate that is just raw land, it has to go up in value for you to make money. If you have rental property, it may still go up in value, maybe just as much, but now you get the rental income. And so you can actually get more return in some ways because you get similar appreciation, but you get the cash flow. And by the way, which one is the one you can count on, Sarah?
Well, the sure thing, right? The rental income that is coming in, that cash flow.
That's right, because when I'm trying to get growth, think about what you need to do. You need to get three things right. You need to buy something at the right time, then it has to go up in value, and then you have to sell it at the right time. So three things have to happen. But if you want if you want interest and dividends, guess how many things you have to do right?
Just one thing.
Just one. You have to buy it.
Exactly.
And you get the interest and dividends.
Yeah.
Now, with rental property, you have to buy it and rent it. You have to do two things. But with stocks, with bonds, and things like that, you just have to buy that interest-paying or dividend-paying security and hold it, and you continue to get that money. So all of a sudden, it takes a lot of that gamble out of the equation. And speaking of that, another myth that I want to make people aware of is that think about the rental income, right? Mm-hmm. You have a property worth $1 million. You rent it for $80,000 a year. The property drops in value to $800,000. Does that mean your rental income goes down by 20% too?
Absolutely not. But a lot of people might think that, Dave, when they're looking at it from the income perspective in their portfolio.
They think of it with stocks and bonds. Correct.
Absolutely, yeah.
But it's no different from the rental analogy. You're going to get the same amount of income,
right,
because it's stated, just like your rental contract.
Yeah. You have that lease with the tenant, exactly.
It's stated in dollars, right? Same thing is true here. If you have a stock that pays a dividend, the dividend is stated in dollars. Even if the stock drops in value, the dividend doesn't change. Now, granted, companies can cut dividends, but they really try not to. It's one of the last things that they want to do. So because it upsets shareholders. So we're going to talk about that more coming up, and how dividends stay sticky. We're also going to talk about bonds and bond-like instruments, and a lot more about why most financial advisors aren't talking about investing for income. I'm David Scranton, here with Sarah Samuels, and this is the Retirement Income Source, where it's all about the income.
Welcome back to the Retirement Income Source, where it's all about the income. I'm Sarah Samuels here with David Scranton, and today we're talking about different myths when it comes to investing for income. Now, a lot of people believe that total return means the same thing as growth, and we've been talking about why they're not the same thing and how you can actually increase your total return, not even focusing on growth, when you focus on the income, and how your dollar amount in your portfolio might drop, but you don't have to worry as much when you know that your income is staying the same. And those are two really big myths that we've covered. A lot of people just don't understand when it comes to investing for income.
Yeah, I think people have talked about growth so much, when really what you mean is you want your 401k to grow.
Right. I want my account, my money to grow.
Right. How you calculate your 401k growing is based upon total return. But they say growth so much, and a lot of left-brain financial advisors go, oh, they want growth, meaning capital appreciation. And that's how I think the terms get conflated. When really, when the average person says growth, they mean total return. And, if you get more income, yeah, you might get less growth, but it comes out in the wash where you could very well get the same total return.
Right. And ultimately, you don't really care, right? Because you are worried about where, the money coming in. So as long as that money coming in is staying the same, you learn why it doesn't matter so much where it's coming from.
Well, it's that real estate analogy, too. Well, that's true in your growth years. In your growth years, you don't care whether it comes from the I or the G. All you want is your account balance to go up every year, right? When you're retired, all of a sudden, the I becomes more important. But we use that real estate analogy to show how, everybody thinks if their portfolio drops from $1 million to $800,000, just to use round numbers, oh, my income must drop by 20%. And that's not true. Because in that real estate analogy, it states it very well. You have a lease with a tenant that says that tenant must pay $80,000 a year of income. If your property drops from $1 million down to $800,000, they still have to pay that much rental to you. Your income doesn't change. And the same is true with stocks. The same is true with bonds. It's those things income is stated in dollar amounts. But what also happens is there's a psychological effect, Sarah. And that's that, if I own raw land and it's worth $1 million and it drops to 800,000, I'm pretty unhappy till it comes back. But if I'm getting 80,000 of income, I'm a little less concerned that it dropped to 800,000 because I'm getting the income.
Right, because no matter what, at the end of the day, you are still getting that income. You're guaranteed that income, so you're not worried about what the market looks like for selling your property. You're not worrying about other things to do with that property because you're getting that income.
And that's absolutely right. In fact, because the converse is true, right? Now, if it goes up to 1.2 million, I'm probably a little less happy because I'm probably not going to sell it because I'll lose the income.
Right.
So you don't care as much if it goes down. You don't care as much if it goes up. But it doesn't mean I have any less appreciation potential or growth potential in that rental property than I do in that raw land. I have the same upside, but I also have the income in addition to that.
Yep. And that's one of the huge parts of this, that psychological feeling of having that guarantee and that more reliable income strategy. So let's get into our Ask Dave question. We have Elaine from North Carolina. She says, if I'm trying to get more income, does that mean I have to take more risk?
All right, Elaine. Well, I've got some good news for you, and that is the opposite is often true within limits. Now, you can try to get so much income. You can get in there and try to get 15% income on your investments that you're buying junk bonds and you get in a recession, they could default. But generally speaking, as you try to increase the income, you lower your risk, right? If you're going to make 10% on something over the long run and zero's coming from the income, now you got to be in things that have the potential to get 10% from the G because you're getting zero from the I, from the income component. But if you're getting 5% from the I, now you only have to get 5% from the G, which means you don't have to take as much risk, if that makes sense. So think of it this way. If you go from growth stocks, like technology stocks, to high dividend stocks, you lower your risk. You lower your overall volatility. Plus, not to mention, if they do go down in value, just like that real estate we talked about a moment ago, you're not as concerned about it because you're getting that income on a regular basis. And the dollar amount of the income doesn't change. Now, what if you go from stocks to bonds? Well, guess what? You lower your risk again. So if you go from growth stocks to high dividend stocks, you lower your volatility. If you go from high dividend stocks to bonds, you lower your volatility and your income goes up. So ironically, when you start to lower your volatility risk, most often your volatility risk actually goes down. Now, Elaine, I want to give you a disclaimer. That means that assuming you're diversified. So assuming you're diversified in any of these compartments, whether it's growth stocks or you go to high dividend value stocks or you go from high dividend value stocks to bonds, you're lowering your risk, you're increasing your income, provided that you're diversified. So in many ways, it's kind of like a win-win, especially if you don't have to sacrifice total return along the way.
Absolutely. Well, Elaine, thank you so much for sending in your question. And if any of our listeners or even our YouTube viewers out there have a question that you would like to and maybe hear the answer on a future show, all you have to do is send us an email to @retirementincomesource.com and you might hear that answered again on a future show. You're listening to the Retirement Income Source, where it's all about the income. I'm Sarah Samuels here with David Scranton, and we are clearing up some myths when it comes to investing for income. So one of the biggest myths that we've talked about so far is how a lot of people believe that total return is synonymous with growth, and how that's actually not true. And you can get more total return from your income and get more overall, which is a huge thing, especially in retirement. Plus, the other idea that people have that your dollar amount income, it will stay the same even if your overall portfolio drops. And Dave, you mentioned the rental analogy, where it doesn't matter if that price of that building goes up or down, because you are getting that agreed upon rental income from the tenant each month. You're getting that guarantee. So Dave, you just answered an Ask Dave question, and you basically said that you can get similar return, but actually take less risk. So if that's true, why do you think more people, more advisors aren't talking about this?
Oh, gosh, that is such a complex question, Sarah, but I'm glad you asked it. I think there's lots of reasons. I think, first of all, a lot of financial advisors are left-brained. So when the average consumer says, I want more growth, again, you're thinking, I want my 401k to grow, which means total return. The advisor is hearing growth, meaning the G part of the TR equals I plus G equation. So I think that's probably part of it and how it started. I also think that a lot of advisors are not true advisors. They're order takers. So therefore, when you come to say, hey, I want more growth, as opposed to explaining to you, even if they misunderstood how you define growth, instead of explaining to you, hey, you mean total return or do you mean growth, and asking the question and then educating you, they become order takers. Okay, this person wants more growth. Well, by golly, I'm going to give them more of the G. And they get into more aggressive things. And it's a path of least resistance because they want to get more clients. And it's unfortunate. In the medical field, we know that if you go in asking for a procedure that isn't medically necessary, the doctor can't do it. Right. He violates his Hippocratic Oath by doing it. But yet in our business, we don't have that. So I think a lot of these advisors have become order takers. Yeah. I also think that sizzle sells. Okay? And the growth is more exciting, right? Think about, the S&P just broke through 4,800 at the beginning of January and went up almost 10% early in the first part of the year. And how did that happen? It happened because the growth component, Magnificent Seven stocks, right? That's exciting. And people like that a little bit, and advisors play into that. But I also think there's just a component of advisors not understanding the math I put forth a few minutes ago, right? I said, over long run, 35 to 40% of the return, the stock market, the S&P, comes from dividends. And I think advisors don't understand that because, and I want to talk about that later at some point later in the show, but I think the issue is that they're looking at saying, okay, the market average is 10% over the long run. The dividend on the S&P right now, let's say, is 1.4%. So the dividend contributes 14% of the return. Well, that's not enough to pay attention to, when the reality is it's a lot more than that. Again, it's 35 to 40% of the return on the stock market over the long run.
Yep, a lot of advisors are just discounting those dividends over the long run. So coming up, we're going to talk about why it actually might be sinful for you to not invest for income. And you're going to love this reasoning here. So I'm Sarah Samuels here with David Scranton, and you're listening to the Retirement Income Source, where it's all about the income. You're listening to the Retirement Income Source, where it's all about the income. I'm Sarah Samuels here with David Scranton, and we've been taking a zoomed out look at all of the facets of investing for income and talking about a lot of those myths out there and busting the myths. So we've talked about how total return is not the same thing as growth, and how you can get more total return overall when you actually focus on income sometimes. Plus, how even your dollar amount of income will stay the same even if your overall portfolio drops. That's another thing people are misunderstanding. But just a few minutes ago, I explained to our audience that investing for income, if you're not investing for income, you could actually almost be committing a sin. So Dave, can you explain to our listeners?
Yeah, it's funny because, we're talking about, we feel like we're income missionaries, and now we're talking about sin and all this stuff. But it's true, the Bible, the parable about the 3 talents, the whole idea in many ways is that, hey, slothful money is not good. And, so think about it this way. If you owned a piece of farmland, that farmland is worth a certain amount of money, whether you farm it or not, right? It's worth the same. It's going to go up, it's going to go down. But would you ever own farmland and not farm it?
Right. Well, what would be the point of owning farmland you don't intend to farm?
Right, because it's going to go up or down at the same pace and value, but the farmland is extra income. If you don't do that, well, then it's essentially lying fallow, not being worked, right? So you'd never have farmland and not work it, unless maybe you leased it out to somebody who would work it. Could you ever imagine having a rental building and not renting out the units?
Well, it'd be pointless. Why would you own a building to rent and not actually rent it out?
That's right, because the rental property is going to go up in value. It's going to go down in value. But if you rent it out, you get more. You get the income component of it, right? If you don't rent it, it's lying fallow.
Right.
Okay. How about if you had solar panels on your roof?
Right.
They're worth a certain amount of money whether you turn them on or not. But why would you have solar panels and not turn them on?
Right. And when you turn them on, you're actually providing that resource. You're powering everything
That
through the solar
renewable
panels.
resource.
Absolutely.
Just like when you take your portfolio to get income, it's a renewable resource, right? Same thing with a windmill. You have a windmill in your yard. It's worth a certain amount of money. Would you ever just leave it turned off?
Right. And you spent the money whether you turn it on or off, so it always makes more sense to turn it on and make it work for you.
That's right. So that's why we talk about it being almost sinful. Essentially, it's money lying fallow. It's money that could be doing two things, and you have it doing just one thing, and that is growth. And unfortunately, that's a problem. And that's the opposite of certain religions, of course, where earning interest or getting a dividend is considered a sin because it's considered passive money. It's considered dirty money, right, in the Muslim faith specifically. But in the Christian faith, it's the opposite. It's like it's lying fallow. Why not take advantage? Why not do something with it that's productive? Why have that asset lying fallow, not producing anything today?
Yeah. Plus, when you're investing for income, you have more options and more choices. So, hey, if you want to tithe the income to the church, that's absolutely an option.
Yeah, that's a renewable resource, exactly.
There you go. Let's get into our questions. So we have Aaron from Michigan. He says, my advisor says he can get me 4% income while also focusing on total return. So what does he mean by that?
All right. This is Aaron?
This is Aaron in Michigan.
Okay. All right, Aaron. Well, it depends. If your advisor is taking the income approach and still focusing on total return, which probably a 5% chance of that, then that means your advisor is doing exactly what we're talking about. But most of the time, what most advisors do is they focus on total return, irrespective of how much comes from the I, the interest and dividends, versus the G. And what they try to do is they try to withdraw money. They get you withdrawing money on a regular basis. And they have some software that shows when back tested over history, there's a very small chance of you running out of money. But, let's make no bones about this, Aaron. You can't spend growth. When something goes up in value, your house is probably worth more now than it was 10 years ago. But it doesn't do you any good, right? You can't sell it. You have to sell it to use it, but if you sell it, you don't have a place to live. So you can't spend growth. When you're spending growth, or you think you are, what you're really doing is you're spending principal, and you're hoping that it grows back. So these are strategies that we call hope strategies, where you back test it to show a high likelihood of not running out of money, and you sell shares every year, you sell principal, and you hope that it grows back at a good enough pace. So what you're doing is you're minimizing the risk. You're minimizing the risk of your running out of money. That's what your advisor is most likely doing. Well, if you have a choice, would you rather minimize the risk or would you rather eliminate the risk? Well, Aaron, I know what you're thinking. Obviously, eliminating the risk is better than just mitigating it. So how do you eliminate the risk? Well, you do that, and I say that in quotes because everything has risk. Walking down the sidewalk has risk. Putting money in a bank CD has risk, right? But for the most part, eliminating the risk is by only living off the interest and dividends and not touching the principal. Because as long as you don't make bad investment decisions, if you're living off the interest and dividends, a renewable resource, and not taking the principal, then you cannot run out of money. But if they're trying to engineer income from a total return approach, then you can mitigate the risk, but you can't completely eliminate it.
Aaron, thank you so much for sending in your email. And if any of our listeners have a question that you would like to, all you have to do is send us an email to @retirementincomesource. That's SOURCE.com. Thank you for listening to the Retirement Income Source, where it's all about the income. I'm Sarah Samuels here with David Scranton, and we've been talking about investing for income, including busting some myths about investing for income. And Dave, you just answered a question, an Ask Dave question from Aaron that I think is one of these important myths when it comes to investing for income. And that's this withdrawal strategy, this retirement plan that a lot of financial advisors out there promote that you mentioned it has a small chance, not zero chance of failure, and everyone kind of hopes, hey, I'm not going to be in that group where it doesn't work out for me. But they're really engineering income, and it's not the same as generating income.
And most of the time, that so-called small chance is probably 10 or 20%.
Right. Is that really so small when we're talking about your retirement?
But your life savings?
Right.
Absolutely not. And the reason a lot of advisors do that, Sarah, you know why they do it?
Why is that, Dave?
Because they're not pilots.
Okay. So you had to get your pilot certification to be an income specialist. Is that right?
No. But in the FAA teaches pilots acronyms. Yeah. And the idea with acronyms is when you're under pressure in the cockpit, if something's going wrong mechanically, you don't have time to think. Your brain turns to mush. So the acronym brings it back right away. And one of the acronyms that they teach pilots is TEAM, T-E-A-M. And that is if you have a risk, do you want to transfer the risk? Do you want to eliminate it? Do you want to accept it? Do you want to mitigate it, right? And most advisors don't understand that they have four choices. They're just trying to mitigate the risk of somebody running out of money. And they don't realize that they can actually eliminate the risk through income. And again, I think that may be a fifth reason. I know we mentioned four reasons in the last block about why I think advisors aren't talking about income. And I think a fifth reason might be because they don't realize that they can actually eliminate it.
Yep. Do you think they're just not really understanding the math overall? Because you mentioned the dividends and how a lot of the S&P return actually comes from dividends, and advisors are discounting them.
So I do think that's true. So how is it that if the market averages 10% and the dividend is 1.4, right? That means the dividend is 14% of the return. So how is it that these academic studies show that the dividend accounts for 35 to 40% of the return instead of 14?
Right. Explain that math. Yeah.
And that's because of dollar cost averaging. So think of it this way. If the market goes straight up, taxes aside, let's ignore taxes. If the market goes straight up, growth and dividends have the same power. The G and the I have the same power. But again, taxes aside. But we know the market never goes straight up. The market takes dips. When the market takes dips, if those dividends are reinvested, it allows you to dollar cost average. It allows you to buy more shares when the market's down. So think about that period of time we always talk about from the year 2000 to the end of 2012, right? The first 13 years of the century, the market was underwater. So if you were a growth investor, by the time you got back to the end of 2012, you were just barely back to break even. You had nothing good to show for it. You were underwater for 13 years.
That's a long time, especially if that 13 years is in your retirement, those retirement years.
It's a very long time, right? Not to mention the fact you need income, but also the fact that, you know, as some of our listeners might know, you know, you're not aware of this yet, but time does speed up as you get older. It does accelerate.
That's actually a scientific study was done. It is true. It does. You perceive it as going faster as you get older.
That's right. And the other thing is, if you think about having a 4% dividend in the first 13 years of the century, if you reinvested that, well, 4 times 13 is 52. You would own 52% more shares, but it's even better than that. Because you bought more shares when the market was down, the price was less, the dollar cost averaging. You might have gotten past 2012, and those growth investors were finally breaking even, and you were up 70%. Why? Because you own 70% more shares. Absolutely, and that's the math most advisors, I think, really just don't understand.
Yep. And there are other reasons, too, why the advisors and maybe the media are not understanding, and it does take some understanding of how the different markets work when it comes to investing for income. So we're going to talk about some of the other misconceptions and why advisors out there, the average advisor, isn't investing for income the right way. I'm Sarah Samuels here with David Scranton, and you're listening to the Retirement Income Source, where it's all about income.
Welcome back to the Retirement Income Source, where it's all about the income. I'm David Scranton here with Sarah Samuels, and today we are busting myths most people have about investing for income. And so far, we've discussed that you don't necessarily have to give up total return to get more income. It simply means you're getting a little more of your return from the I and a little less from the G. But also how if your investment goes down in value, your income doesn't have to increase. Why? Because in most investments, income is stated in dollars, not percentages. And then also, we just had some fun, Sarah, talking about why it might be sinful not to invest for income.
Right. You don't want your money to be slothful, right? You want it to work for you and generate income the right way. Plus, Dave, you answered a really important Ask Dave question from Aaron, I believe, in Michigan, who wrote in asking or telling you that his advisor mentioned there's a way he can get 4% income while focusing on total return. And we kind of debunked that myth that his financial advisor is actually talking about that withdrawal strategy, the idea of engineering income, which is not the right way to get income.
Yeah, because you can't engineer income. You're selling shares and you're crossing your fingers and toes and hoping that they grow back. So it's very much like having a 30-unit apartment building and you retire, and your plan is you're going to convert it to condos and you're going to sell off 1 unit every year in retirement.
Yep.
So the first year you sell off 1 unit, you live on the proceeds, and you have 29 units left. So if they go up in value just a little bit, you're okay. After 2 years, you sell off a second unit, you have 28 units left, right? But when you get out 29 years, you only have 1 unit left. And now that unit has to have appreciated enough to last you the rest of your life. Now you might think, hey, I'm not going to live more than 30 years in retirement. Gosh, that's way out there. But what if you do? And that's the risk when you start to try to engineer income by selling principal. You're literally, it's a hope strategy. You're literally selling principal and hoping that it grows back. And like we talked about, that's trying to mitigate the risk. Well, why mitigate it if you can eliminate it?
Right.
And the only way to eliminate it is through renewable resources. Like, think about it. We talk about eliminating risk of the planet, right? With carbon.
Mm-hmm.
Well,
reducing that risk.
That's
Absolutely,
right.
yeah.
So you can manage the risk by and I'm not a proponent of just stopping all fossil fuels and everything else, but the only way to eliminate the risk would be to go 100% to solar, 100% to wind turbine. I mean, that'd be the only way to eliminate it. And that's not practical, so we're forced to mitigate it by growing a little bit more green, and hopefully we can replenish the carbon footprint over time. But the reality, or at least not deplete it worse. But the reality is when it comes to income as a renewable resource, it's really easy to completely eliminate that risk. Not just mitigate the risk, completely eliminate it.
And going back to your rental building analogy, Dave, sure, let's say, everything is going well. You're selling 1 condo each year and it's going well. But then what if there's a real estate crash? What if everything crashes and bottoms out and now you can't get any money in that condo? You could be in big trouble. And that's what we've seen with history. So let's get into our question. We have Florence from Tennessee. She says, is it possible to match the stock market returns in the bond market?
Hey, Florence, great question. And the answer is sometimes. Sometimes. So if you take that 10% over the long run, and I'm taking some literary license here because I always talk about bonds and bond-like instruments on this show, where with bonds and bond-like instruments, you can, today, without taking crazy risks, you can get in the 6-7% yield range. So if the stock market averages 10, how do you get from 6 or 7 up to 10? Because remember, bonds have less risk than even high dividend stocks. Well, there's 2 ways to do it. One is by not spending all the income and reinvesting some of that income and letting that grow. So that's one way to do it. So if you need 4%, you're getting 7. You can reinvest, you get inflation hedge. But there's another way, and that is really prevalent right now. And that is because we know that when interest rates go down, bonds and bond-like instruments tend to go up in value. When interest rates go up, bonds and bond-like instruments tend to go down. So right now, a lot of these instruments are at a discount. So if you're talking about bonds, a lot of bonds are selling below par value, below face value, which means you'll get a little more income when you buy them today. But also if you hold them to maturity, they will come due at par value. So you get some capital appreciation. So now that growth, that G component, to make up for that extra 3 or 4%, right? The difference between 10 in the stock market and your 6 or 7 maybe from the I in bonds and bond-like instruments, that extra growth can be built in because you're buying things at a discount. And this is whether you're buying preferreds, for example. Preferreds have a fixed dollar amount dividend. Again, not percentage, dollar amount. So when they drop in value, your income doesn't drop. So right now you might buy some preferreds for $22. Well, the par value is $25. That means you have 10% growth built into that in addition to your income. So this is really a great time to be able to get some growth in bonds and bond-like instruments just because of where the prices are on some of these investments right now.
Yeah.
And that gives you potentially get upside potential with less risk.
Yep, a unique opportunity right now. Florence, thank you so much for sending in your question. And if any of our listeners or even our YouTube viewers have a question that you want to, please send us an email to at Retirement Income Source. That's SOURCE.com. And thank you for spending some time here with us on the Retirement Income Source, where it's all about the income. I'm Sarah Samuels here with David Scranton, and we have been covering investing for income. We've been talking about all of the different myths surrounding income, like total return is the same thing as growth when it's not, or this idea that you have to take more risk and you'll get even less income, and that's not true as well. And Dave, you just answered a question from Florence asking about matching the stock market and the bond market, and you mentioned there's different ways to do that, including reinvesting your income and not spending it. And I think that is a great reason why people should consider making that transition to income when they don't need the money, so that they can reinvest it and grow their portfolio and get more income when they do need it.
Of course. And we always talk about that transition having to be ideally 10 years before retirement. And why? Because, beginning of the century, we had 13 years and the market was underwater, right? So even if you want to stay in high dividend common stocks, by having made that transition in 2000, even if you're planning to work until 2013, you still would have been better off because, again, you would have owned 70% more shares, which means you would have been up 70% when everyone else was barely breaking even in the markets. So it's a great chance to make that transition. Now, if you're closer to retirement than 13 years, then you probably don't want to be all stocks. You want to have some bonds and bond-like instruments mixed in. And especially now, it's a perfect time considering that most of those things can be bought at a discount, which means that there's a built-in capital gain there, providing, of course, that the issuer of the bond or bond-like instrument doesn't default or go bankrupt.
Yep. And I think one of the most important things to focus on when it comes to investing for income, and we talked about it a little bit earlier, but it is that guarantee, which gives you that feeling of being comfortable. You don't have to worry where your portfolio is, right? Because you know you're getting that income no matter what. So if it drops, you're happy because you're getting that same income. It goes up, you shrug your shoulders, right? Because you're still getting that same income no matter what.
That's right, like the rental property, 100%. And we talked about why financial advisors don't do this, and I came up with a bunch of guesses. And I thought, first of all, because when people say growth, they want their money to grow, and the advisor is thinking, the growth component of the equation.
Taking them literally.
The G, that's right. I also think that a lot of advisors are salespeople. They're not educators. So as a result, if you want growth, yes, ma'am, we're to get you growth. Even though you might be defining it differently, they're going to do that. I also think advisors like the sizzle. Right, the excitement,
the glamour, and the glitz, right?
As do some investors, right? That's why
of
people
course.
go to the casino, right?
Yep.
So there's a lot of that.
They like to gamble.
They also don't understand the math. And like I said, the analogy I made was the S&P at a low dividend yield would have ended up with 35 to 40% of the return of the market over the long run. But what if you had a 4% dividend? What if you tripled that dividend, right? Now it could be even more return enhancing. So I just think that. And I think the other thing, too, is a lot of advisors feel like they have to justify their worth. And this might be a little bit more cynical, but, think about it. If I had you in a portfolio of nicely laddered, high-quality bonds, very little default risk, you just buy them, you hold them to maturity, it doesn't require any active management. Let me ask you, are you going to want to pay me a management fee year after year for that portfolio that's that safe, that doesn't require a lot of management?
Well, not really, because you're not doing anything after the first time of buying the bond.
That's right. So I think that's the other reason why most advisors don't want to eliminate the risk. They want to mitigate the risk. Because if there's still a little bit of risk, it justifies their existence. You feel like you need somebody to manage it. So again, lots of reasons why I think that so many advisors out there aren't talking to their clients the way we do right here on the show.
Yep. And every week we love talking to our listeners, especially about all of these important retirement topics, including investing for income. So if you enjoyed today's show, we would appreciate if you send it to your friends and family, and you can watch every episode at retirementincomesourceradioshow.com.
And most importantly, we hope you join us right here next week. Same time, same station. I am David Scranton here with Sarah Samuels, and this is the Retirement Income Source, where it's all about the income.